Hello, everybody. So, as you know, I'm very passionate about stocks, which is kind of why I started this YouTube channel so I can talk about stocks. And I buy stocks every week. I set aside a portion of my salary and I put it into stocks. And every week I buy my favorite stocks. And so this is the 4 stocks that I want to look at this week that I think are undervalued in my view and good buys right now for me based on my investment profile, right? No advice whatsoever. So the first stock that I want to buy is Tesla this week. And I know I made a few videos on Tesla and people tell me everybody talks about Tesla. Well, everybody talks about Tesla perhaps because there is some wisdom of the crowd going on behind Tesla. Tesla had a great event and it was overlooked. You even have people on Seeking Alpha like criticizing, saying the event was really, really bad. I think it's misunderstanding. I watched the whole event, almost a 4-hour video, and I thought it was outstanding. One of the key things we learned in the Tesla Investor Day event is that they are pounding the table on the 20 million vehicle goal, and they're doing everything possible. We know actually there's going to be another mega factory. There's going to be 2 mega factories that they're going to open. We know that these are likely going to take less than 9 months to build. We know that they're giant vehicles, giant manufacturing vehicles, right, for vehicles. We know a lot of good things are happening. And so if you look at that $20 million goal, it's actually in line with what they've guided, right? Elon Musk has said multiple times, we're going to grow at 50% a year until 2030. Well, if you grow at 50% a year until the end of 2029, i.e. 2030, you would get at 22.27 million vehicles at the end of 2029. That is the magic of compounding, right? Compounding at this rate. And by the way, for those who may say that's crazy, that would not be that crazy, because that would be, if they reached about 20 million, that would be about 25% of the world's automobile market. And so if you think about what happened in the cell phone market, there were hundreds of cell phone and they got replaced by essentially Apple and then a software called Android, and a whole bunch of different makers making Android phones. So the whole market got replaced by 2 players. Now, I'm not saying this is what's going to happen for the auto, but I'm saying the biggest player in the auto sector is likely going to be much bigger than the current biggest player in the legacy ICE sector. And so if Tesla just gets 25%, that would be 20 million vehicles a year. And if you did that, right, 20 million vehicles a year sold at 50,000 a vehicle, that'd be $1 trillion in sales. And if you apply a very reasonable price to sales of 5, which is much lower than what currently Tesla is at. It's even lower than Apple, actually. It's a tad higher than Google. If you take a price to sales of 5, you get at a $5 trillion market cap. Of course, Tesla is trading at 600 billion right now, so you're not quite at a 10x, but almost a 10x. So that's why I'm investing in Tesla. I do want to say one more thing about Tesla, which is why I think the valuation of Tesla will be higher in the future. Right now, the valuation is pretty low, right? Because they only have 26% gross margin. But if you follow Tesla, they've been going through what they call production hell, and their margin has been going down because partially due to supply issues, partially due to hurdles they've had building their plants. They had quite a bit of issues in manufacturing throughout 2022, and there's reasons to believe that those manufacturing issues throughout 2022 will not happen again in 2023. At least that's what I believe. That's the feel that I get when I watch the investor presentation. And so if they go back to, say, between 30 and maybe even 35% as they sell more software margin, it's easy to imagine a valuation that's way more up, right? Because gross margin right now is pretty low, even though for an auto company it's unheard of, right? But for a tech company, that would be pretty low profits. They're going to increase those profits. Now, how do they plan on doing that? Well, this company never ceases to amaze me when it comes to efficiency, right? This is an example of how they build their superchargers, right? They put them on a truck, pre-build them in trucks, just put them in there. It takes them days instead of like a month to set up one. They create their own ASICs, right? Their own semiconductors that they design from scratch. That way they avoid buying plenty of semis from different third parties who all charge their own margins. No, they create their own ASICs. They're redesigning the plants so that you can have less of a footprint in your plant, manufacture more in less space. This is an example of improved flow of manufacturing. They want to be the first one to manufacture cars unboxed, as they say, which kind of entirely disrupts assembly lines, and you have parallel assembly lines which merge at the very end of a line, as opposed to have one vehicle who goes through assembly line. So by doing that, you remove a lot of bottlenecks. And they have so many different innovations. That was a long presentation. I can't summarize it. But another one, for example, is they're moving to a 48 volt architecture. And by moving to a 48 volt architecture, they're going to be able to save so much copper, so much rare raw materials, and they're using RJ45 connections instead of using wiring connections. So they're going to have much more efficient vehicles that are going to use less and less, become more and more minimalistic. And the more the vehicle becomes minimalistic, the higher the gross margin improves. And for Teslas, I firmly believe we have just begun that S-curve. We have just begun that S-curve. This is the typical adoption curve, and Tesla in the US, for example, is about 4% of all vehicles sold. EVs in the US are about 6%. We're past that 5% threshold where the technology is usually getting adopted, and I strongly believe this technology is going to get adopted by everyone. It's unclear for a lot of people right now, but it will become clear, right? This is a chart I've put out multiple times in my videos, but Tesla, for example, Tesla is a $7 charge versus a $70 full tank, right? They can last up to 1 million miles versus 200 miles. Very few moving parts, hundreds of moving parts, no maintenance, very high maintenance for legacy autos. Software updates, you don't have to go to the gas station. Gas stations are unsafe. There's lots of crimes. Legacy auto, you have to go to the gas station. You buy it online, and if you buy legacy auto, you have to go to a dealership. You're unlucky. Anyways, there's so many different things. But again, the most important thing that Teslas have, in my view, in my opinion, is the fact that it's so cheap, it's so inexpensive. And $7 charge versus $70 full tank, that's a 10x, right? That's a 10x cheaper. That's my usual calculation. But we're pushing this calculation even further by entering the electric market and offering electricity plants. And they're rolling this out in Texas in July with their own electric plan, where you have unlimited at-home charging for your car. And so let me tell you this little example, right? I know a family mom. She has 4 kids, drives about 180 miles a day between different classes, school, practice, extracurricular activities of all sorts. And because she drives 180 miles a day, that means she needs a tank. Down here in Texas, that's cheap. She needs a tank about $50 a day, $50 every 2 days. She has to be at the gas station to fill up. Well, that is $750 a month in gas. And so if you were to switch to a Tesla and use their attached grid electricity plan, right? Their attached utility plan. You're going to move from $750 a month to $30 a month. So we literally have a technology who has the ability to be 25 times cheaper than the current technology. And if you follow this channel, you know that I repeat a lot that actually this is going to become free because of a convergence of home energy. And so you're going to have solar panel on your home, and you're going to make your own electricity. So this is going to lean towards near free. And I mean, this is essentially almost free when you go from $750 to $30. Lastly, when I look at the price to sales of Tesla, I look at this and I'm like, okay, you can buy Tesla at the same price to sell level that you had in about 2016, 2017. So you can go back about to these levels and buy Tesla right now at the same price to sales level. Of course, the nominal stock price is much higher, but really the price to sales, the ratio is what matters, and you're buying it cheaper than you could have bought in a very long time. So I'm very, very impressed by this low price for Tesla. All right, let me move on to another stock I'm planning to buy this week, and it is Enphase. So as you know, I'm perhaps as bullish on Enphase as Tesla, even though my Tesla position is much bigger. I am very, very bullish on Enphase. Actually, if you put Tesla and Enphase against one another, they're respectively the first and the second highest performing stocks in the S&P 500. Isn't that interesting? At 50%, right? Roughly 50% annual return over the past 10 years, which is absolutely insane. I believe this will continue because this technology is real. It is a revolution. It is a real technology. It's not a fad. It's not fluff. It's real. And when you see what Enphase does, I believe Enphase as the winning solution in the microinverters. The solar panels are moving toward microinverters. One panel, one tiny box like this called a microinverter, which converts your current from DC to AC, and I believe Enphase has a great competitive positioning. They are 99% of the market for microinverters. They almost embed their inverters in other manufacturers. Like for example, if you buy a SunPower solar panel, you're going to have embedded Enphase solar panels, and Enphase has had a very recent boost to its future. But if you look at the stock price, you wouldn't know it. But the boost from the Inflation Reduction Act is absolutely going to be insane for Enphase, because if you look, for example, for this 167 retail price inverter, which means they probably sell it at a little bit more than 100. They probably sell it to their suppliers, to their distributors. Sorry. Well, that means that you're going to have maybe 45 to 50% of the sell price of the product covered by subsidies. And remember, their margins are in the mid 40%. So my guess is that their cost of goods sold are going to be almost entirely covered by the IRA bill. And this is especially true as, Enphase is savvy and they're going to move forward with as powerful inverters as they can. This is an example of 480 watt inverters. If the government is paying you 11 cents per watt to make an inverter, you're going to change your product lineup to have inverters that are nearing 500 watts, and why not even more, because you're getting paid 11 cents, right? So it doesn't cost that much to add more wattage to the system, but you get the subsidy. So these subsidies, absolutely insanely great for a company like Enphase. Not that they need them, quite frankly, not that they need them, because their product has essentially won, in my view. This is an example of how well they do in Australia with their microinverters. I encourage you to watch this video. If you want a technical explanation as to why microinverters are the future, in my view, and why I think they've won, I would really recommend this Gary Does Solar video, where he goes into 25 minutes of depth explaining all of the reasons why solar installers, anybody in solar today, recommends microinverters. Unless, of course, they're selling legacy inverters, but there are fundamental reasons why it's better from the standpoint of safety, from the standpoint of each panel being its own mini solar plant or solar system. It removes a lot of issues that there were with large string inverters, and they also last twice as long. Inverters have the advantage that they have the same length of warranty as solar panels. While if you buy a regular inverter, typically you'd have a 10-year warranty. So over a 25-year lifetime, you'd have to change 2.5 times your string inverter versus a microinverter. So anyways, many reasons why it's the future. Enphase has so much more going for it too, over than just inverters, right? They're an home energy independence play, and it's so clear to me. Like, if you have 12 panels on a house, you're gonna have 12 microinverters, right? That's well over $1,000. And then Enphase sells a whole bunch of add-ons, right? They recently got into charging, EV charging, and bidirectional charging. They sell their own batteries, they sell their own combiners, their own Wi-Fi or cloud monitoring system. They help you make money by reselling electricity to the grid. They work very well with other brands, right? I mean, in the future, you can entirely imagine having an Enphase system with an LG Chem or with a Tesla Powerwall, and I believe this is the future of energy independence. This is especially true as electric bills and electric prices are going through the roof across America, and not even to talk about outages. So I really believe in this company. Furthermore, today, most solar has a payback of about 5 years, but that payback is going to get way lower. And this is the chart that I always show. But the cost of batteries, per my estimate, batteries should be about 4 times cheaper in 2033 than in 2033. So if they're 4 times cheaper, that means all of the things that we wouldn't conceive of possible today become possible, like having a household with 3 electric cars at home, saving electricity for the month, for say a rainy month next month. I mean, there's so many things that happen, and the solar panels are getting ever more efficient. They become ever cheaper by the watt, right? They are getting cheaper and cheaper, and their efficiency is also stunning. I was on a solar calculation website the other day, and they had a regular, high quality and ultra premium panel efficiencies, and I was making calculations, and most of the cheap solar panels today correspond to the high quality efficiency of like 5 years ago, which is stunning to me. So they're increasing in efficiency, these solar panels. Anyways, I believe in this technology. I think this is the future. I think Enphase has a lot of potential for disruption. And when I look at the price to sales ratio of Enphase, sure, it's a little higher than Tesla from price to sales, but remember, they have higher margins. However, as far as the price to sales, this stock has been in a free fall. If you compare it to the amount of sales they've been growing ever since the market turned its back to innovation and innovative companies and sold off. So I actually believe Enphase is very, very cheap, even though if you just look at the stock price, you wouldn't do it. You wouldn't know it. But if you compare this to their sales growth, you can see that, in my view, it's a cheap stock. All right. Third stocks I'm buying this week is HIMS. So HIMS, interestingly, let me start here. HIMS stock price is back to the pre-earnings number. But that makes no sense, right? It's down almost 20% ever since it's got its spike past $12 a share. It's down, but it makes very much no sense because even though they gave us bad guidance, I would argue, for 2023, no one's buying that guidance. I'm not buying that guidance at all. But I just think that for a company like HIMS, so HIMS, if you don't know, HIMS is in the preventative healthcare space. They sell a lot of health products that have historically been stigmatized through their websites for HIMS and for hers. And they're doing very well. They're a telehealth company that does not use health insurance. They're a telehealth company that treats with all sorts of issues like hair loss, for example, who would usually not be covered by insurance and would be really, really, really hard to get by the healthcare system, because really the healthcare system that we have is more of a sick care system. It's really good at curing cancer, it's really good at surgery, but it's not so good at anything that is preventative, i.e. any issues you would have, say, in your 40s. It's not as good as that. So that's what HIMS does. Anyways, the guidance for 2023, in my view, is pointless now that we have 2025 guidance. Because with 2025 guidance, we can calculate, and you can stop the slide and go for my calculation here, by just using the same price to sales multiple that we have today, applying it in exactly 3 years, we get to a company that's 5.7 billion in exactly 3 years. So that would be a 2.65x once money in 3 years, which is why I'm investing in HIMS, because the risk now in HIMS is much lower, because we know the long-term guidance. So we have much lower, I argue we have much lower risk, and I see HIMS as a de-risked play now that we have this visibility. It's all about uncertainty, and how much uncertainty do you have? The CEO giving me that number is removing a lot of uncertainty from my HIMS thesis. CEOs have a fiduciary duty. It's not like they can lie and make up stuff. Anyways, so that's why you have a 38% per my calculation average annual return for HIMS. I'm very happy to hold HIMS. I plan to hold HIMS until past 2030. I believe they are in the right place at the right time, and they have their positioning in the right place. HIMS has plenty of more products coming. You can pause the video and look at all of the products that they are coming in the future. it's really a stock with sticky revenue. They have the margin profile, gross margin profile, and recurring revenue profile of a SaaS company. But they are not a SaaS company. They're a preventive healthcare company. They just reached more than 1 million subscribers in the United States. I believe they have a lot of opportunity, just like a lot of neobanks, for example, a lot of opportunity for cross-selling, i.e. if you have a couple, say a man and a woman, and he uses HIMS for something, she is more likely to trust HIMS, and there can be cross-selling that happens across couples, which I think is very, very interesting. This positioning, this gender-specific positioning, HIMS and hers, and then you have cross-couple selling, where you obviously have a lot of trust, which makes referrals very, very easy across couples. So I think this is very interesting. They also have a lot of cross-selling opportunity within users, although you want to be careful. You want this to be legitimate needs and just not sell products that people don't need, because we're talking about helping out people with heavier health, right? You can't just give drugs to people that don't need them. But I believe this company is highly aligned with the way healthcare and healthy living is headed, and I really like it. I really like it. When I look at HIMS, right? So the stock went back up from 2022 a little bit, but compared to its potential, I do not feel bad paying $10 for HIMS right now at all, because when I look at revenue growth, I know that revenue right here compared to revenue right here is about 60 to 70% more. So they've increased their revenue by a mile. Companies over time, growth stocks, at least those I cover on the channel, over time greatly increase their sales. So if a stock is flat but the sales are growing at 50%, your stock got way cheaper. And if your stock price grows in line with your revenue, your stock technically didn't really move in price. And so by the way, when I see that stellar revenue growth, they've never failed below 85% year-over-year revenue growth, which is stunning. And actually, the CEO for Q1 is guiding 79%. So we'll see what happens. But when you see this growth, you understand why I think it's hard to believe the 43% that they guided. But to me, it all became irrelevant as soon as we got the $1.2 billion guide. And lastly, a company that I seem to be the only one who's excited on YouTube. I don't see many people talk about StoneCo, but I'm very excited about StoneCo. This is all about charting your own course and choosing your investments on your own without anybody telling you if something is good or if something is bad, right? That's why we all say it's not investment advice, right? No, it's not. But when I look at a company like StoneCo, I don't understand why it's so cheap, because this company is still trading like it's going out of business, even though the analyst consensus is telling me that they're going to have 54% of growth over the next 4 quarters. 54%. What does StoneCo do, by the way? Well, StoneCo is an investment that both Warren Buffett and Cathie Wood have backed. They both love that stock. And it is the best way to look at it. It is the Square payments of Brazil. So they have a solution that is essentially just like Square. And they also have a point of sale, an ERP solution, a software solution for their merchants. And so I like to think about this as, say, a QuickBooks. So when you look at Stone, I'm like, okay, you can say it's 75% a Square payments and 25% a QuickBooks. That will be my best way to describe it. Nonetheless, they have products that are very, very timely, very, very in with the trends and with what customers want. And when I look at this company, I am not worried. When I look at this company, I see they have a lot of cash on hand. They have some debt, but they have way more cash. They have positive free cash flow. I don't think bankruptcy is a concern. They have stunning gross margins at 74%, ridiculously cheap price. And by the way, feel free to stop on this to look at my calculation. I made a full video about StoneCo as well. But even if you were to use PE, which I don't use on this channel, even if you were to use PE, you'd be at a forward PE of 13, which in any universe is cheap. But I don't look at PE. I look at gross profit. I invest for growth. I want to be out of the stock by the time PE becomes what everybody wants to value the stock with. I want to be out of that stock and move into a higher growth stock, into a faster horse. And when I look at their dilution, it's important to note most of their dilution has been linked to a recent acquisition. The insider ownership is also extremely high at 39%. Productivity is high for Brazil. StoneCo has a lot to do with it, and as a lot of good things going for it. And when you look here, I just want to briefly talk about why the stock crashed. If you look at the StoneCo crashed, they crashed much earlier than any of the other stocks in the market because they had a problem with the Brazilian collateral registry. They had a problem with the collateral registry and they lost hundreds of millions of dollars because they've made a big mistake. Now, they have corrected this mistake. This mistake is not a problem anymore. But the stock is still forgotten and thrown out. And I obviously started becoming interested in StoneCo after we heard about the mistake. It would be too bad. I mean, I understand if you bought the stock right here and you saw this big problem arise, you would be pretty upset with StoneCo. But right now it is de-risked, I believe. It's no investment advice, of course, but I believe they've solved their issue, and the stock has been dead money. It's been flat, for over a year now, and it's just trading at the lowest price to sell ratio we can possibly imagine. So anyways, these were my 5 stocks that I am looking to buy this week. This was not investment advice. This is just entertainment. Thank you for watching. I appreciate your likes, appreciate your subscribes. Thank you and have a wonderful day.